Investors are broadly on edge after Walmart's CFO said the company saw customer purchases slow in the back half of October and that they are thinking slightly more cautiously about the consumer versus 90 days ago. My next guest says that even Target, which soared yesterday on better earnings, looks to be facing a deteriorating consumer backdrop in the weeks ahead. But are these concerns already priced into shares or not? Let's ask Christopher Horvers. He's JPMorgan senior analyst covering the broadline and hardline retail space. It's great to have you here, Chris. Welcome.
Afternoon, Kelly.
Can I just ask you what you think is going on here after sifting through these reports the last couple of days?
Yeah, I think you're seeing earlier in the year the headwinds on the goods retailers was basically share of wallet. You had revenge travel, you bought everything for your home, you bought your workout equipment, during COVID. And so you had this long tail of headwinds. What we've observed really since August is more cyclical headwinds. So we're seeing weakness on the low-end consumer. Walmart talked about this on their call today. People are increasingly awaiting for events to shop. So until it's on sale, until it's so close to need, I'm not going to buy it. And that continues to exaggerate over the year. And then the other piece that's going on is really pricing. So you have disinflation in food. So food inflation, which is 2/3 of Walmart's mix, was up double digit to start the year. Now it's 3%. So that's naturally slowing things down. But what's not happening is the units picking up as prices settle in.
True.
So that's problematic. And then the last piece is you're seeing a ton of deflation. Most of what you buy around the holidays and for Christmas is brought over on a boat. And with ocean freight rates coming way down and demand coming down, you're seeing massive disinflation in goods, appliances, furniture, home furnishings, and other electronics. All that product is coming in at a much lower price without any unit response. So in summary, it was share of wallet. Now it seems much more cyclical and low-end oriented.
It was share of wallet. Now it seems much more cyclical and lower-end oriented. That is very well captures, I think, what investors are gleaning here. So what does that mean for the stocks? Target, obviously, you could say, well, a lot of bad news was already priced in. Maybe it can do okay. Walmart's always been kind of a healthy name to own in a portfolio. Strategically, what's the play here?
Yeah. It's very muddled right now because normally into a slowdown, you want to get defensive and you want to own something like Walmart, which is more grocery-oriented, more staples-oriented. But the problem there is that disinflation in food and weakness at the low end really hits them very hard. And it's a name, as you see today, which is down 8% because it was owned and expectations were high and people are hiding in it. So I think at the margin, it's tougher for Walmart. And I also think it's tougher for Target because they're 60% general merchandise. They also are exposed to the low end, although not as much as Walmart. So the names that we would be buying today include Mighty Costco, that's an above average consumer with tremendous share gains and loyalty. We would be buying Ulta Beauty because beauty is still a good category. There is still some share of wallet reversion going on. And you have generational trends with Gen Z and millennials being strong adopters of social media and beauty. And at the same time, the vendors really need them. And the last area that we're really focused on is the more defensive names that tend to do well if you do have a consumer recession. And that's really the auto parts retailers. So an AutoZone and O'Reilly, very needs-based, have a lot of strong pricing power, and that consumer tends to focus more on needs and maintaining their vehicle against buying discretionary items.